Awesome. All right. Perfect, guys. Glad that we were able to jump on this and get it figured out. How's everyone doing? First of all, I usually have a moderator, and today we're not going to have one. It really is just, ask Ryan anything. What's interesting is that we had a copywriter reach out the other day and say, hey, listen, what is it that really everyone wants? What are they looking for? People have questions. They can't get a hold of the managing partner, right? They want to ask specific questions. So today is about you all, right? It's about our investors. Everything at MF Capital Partners is investor experience and everything we go through. So every time that we start up a webinar, one of the questions I like to ask is, where is everyone from, right? How do we know you? So if you guys don't mind, if you don't mind putting in the chat, where are you guys all from? Obviously in multifamily, markets are important to us, right? So for us, I want to say we range from Orlando, Utah, Hawaii, but we have two offices, an office in Maui and we have an office in Orlando. So tell me where you guys are from. All right, let's see. You're putting in the Q&A. Do we have a designated coach? Can I please have the link? Let's see, chat is disabled. All right, we'll get that chat enabled. So for now, Brett Davenport. Oh my gosh. We got Brett. I'm a little nervous now. A little nervous, got Brett on here. Actually, guys, I know Brett. We've done several deals with Brett and his team. They are down in Houston. They kill it. They do a great job. So we got North Carolina. Alan, thank you for that. Yeah, it's disabled. I reached Orlando, phenomenal market. We'll talk a little bit about that today. I see a hand up here. I see Nevada, Tampa, San Antonio. All right, chat is currently disabled. Flip the switch somewhere. I do not know, Derek, how to flip that switch. All right, so if you guys want, you can just do in the Q&A. We'll go from there on this one. From Utah. All right, Utah. I was gonna make a bad comment about Utah, but listen, Utah is a great area, right? I have a lot of fond memories of Lake Powell. In fact, my grandfather, a lot of people ask, right, how did you get into the business? I got into the business because I had a grandfather that owned multifamily in Sacramento, California. So those of you from California, you'll know that area. So Sacramento, I actually grew up in that area. My grandfather left some generational wealth for us, which is what a lot of our investors want, generational wealth. He's able to leave a trust fund for us. It lasted almost 28 years. 28 years, it allowed us to go spend time with aunts and uncles and cousins. That place that we designated was a place called Lake Powell. It's like the Grand Canyon filled with water. Never been there. I recommend getting there. So it's an amazing area. But my grandfather, that was important to him, generational wealth and family, keeping family together. So, fortunately, I was able to see that in my grandfather's life and the life he created for his kids and his grandkids and his great grandkids. That's one of the reasons we started the investment company, is so that we could do that. Part of this is we have everyone here in the, in the Q&A, and that's fine. Looks like, gotcha, okay. As it looks like the chat may not work on this one, so just do your Q&As in here. Today's webinar is about asking me whatever you want about the market, investment opportunities, what we're looking at currently right now. What is our due diligence? It could be an array of questions. It's really like I used to be single. I got married in November to a beautiful woman. I have 6 kids now. And the thing is, I used to joke before that, it's like speed dating, right? So I like to have a good sense of humor. Sam, it's good to see you on here. Mr. Passanisi is awesome. Good to see you on. So today is about, questions for me. So let's go ahead and shotgun it out, man. If you have a question for me in the chat, or not in the chat, but in the Q&A, go ahead and put it in there until we can figure this out. Would you give a firm engineering advisor 20 plus years in the industry nationwide to conduct your firm's assets, real estate tax strategy, cost segregation, 1031s, property taxes, even raise capital through grant services? And congratulations on the marriage. Thanks so much, Gabriel. Awesome. So I'm not sure what the specific question is, but tax strategies. I was going golfing last week with an investor of ours. And anyway, we were talking about tax strategy. His son actually works for a company that teaches tax strategy. And we're going over all different trusts and insurance plans and different plays that you can do. And it's phenomenal, right? I actually laugh at the politicians. I don't care what side of the aisle. I really don't care. If you've been on one of these webinars, you know that I really don't care about political stances or beliefs. But what's interesting is they create tax strategy for us. I used to always think, my uncle said out of college, he said he owned a CPA firm for 40 plus years, right? And he taught strategy. And he said, Ryan, who creates it? And when I was a young kid, I thought the IRS did. And he said, no, let me teach you a real strategy. Politicians do. And what's awesome about that is they create all kinds of different ways to protect us. Recently someone said Trump doesn't pay taxes and they were frustrated with that. And I was actually talking to this guy's son about that. And the reality is both sides of the aisle take advantage of the real estate benefits. So a lot of people bring up, Gabriel, they bring up 1031 exchanges because that's all they knew. For years, 1031 exchanges were there. All you were doing is kicking the tax, burden down the road. And eventually, who pays that tax burden, right? Who pays the tax burden, with 1031 exchanges? Well, it's whoever, inherits it, right? It's whoever inherits that 1031 of those properties, right? They're going to pay inheritance tax. They're going to pay a gain on that deferment of 1031. But the reality is this: a couple of years ago, cost segregation, bonus depreciation came to the picture. It was a beautiful thing, right? How do we go in and how do we take advantage of $1 today versus $1 in the future? It's no secret that it's been talked about that long-term capital gains is eventually going to go into 40%, right? It's going to go into a 40% tax rate. And so if I can take advantage of taxes today, that's what MF Capital Partners does. We invest alongside our investors, and so we're always looking for those tax benefits. The benefit of cost segregation is allows us to take any gains that we have and offset it today, right? So if we had a 1031 instead of doing the 1031, where let's say you had $200,000 in tax liability, let's say that you were to put a couple $1 million into the deal or a couple $100,000, and you were to get 50%. So I'll use the $100,000 example because it makes math simple. If you did $100,000 and got $50,000 in depreciation, what does that do? What allows you to offset tax liability in passive investments? Well, a 1031 probably was a passive investment in whatever deal that you were in. Okay, so that allows us to offset whatever gain that we potentially would have. You see that? I'm taking advantage of it today. In the future, there's always going to be a tax strategy that some politician creates, right, to offset their tax liability. Today's market is cost segregation. So Gabriel, I love the fact that you brought up cost segregation 1031. Now you've got to go ask your CPA what makes most sense for you. If it's $400,000 or $500,000 in cost segregation, in 1031, it may make sense for you to go put it in a deal that has cost segregation. Now, if you have $4 or $5 million, $6 million in 1031 money, it could be a completely different strategy. Cost segregation may not be the right strategy for you. Now, you got to remember the different states that you live in impact you differently. I believe Oregon's one of them. California is one of them. That you can't take advantage of bonus depreciation. So make sure you get with your CPA on that. Leonard asks, what are your favorite exit strategies for properties? Right. This one thing I love about everyone looks at acquisition and what I can get into. The right question you should ask as an investor is, what is your exit strategy? How have you exited previously based on your track record? Yeah, our track record is, our investor relations team will hate this. Our track record will actually hate this. Our track record is 38%. I hate that number. I actually hate it. That was during a time of how how the market works, right? There's ebbs and flows. What we call is there's cycles. I have to know how cycles work. Fortunately, we sold off a large part of our portfolio during the height of the last market, right, in 2021. I think a lot of you guys could admit that in 2021, right, we were selling, properties for crazy amounts. Why is that though? We sold it because cap rates were low, interest rates were low, and money was readily available. So I want to make sure that I know those exit strategies. When I go into a specific market, I want to be able to look at and go, hey, based on the market, it's a 3 to 5 year hold. It might be a 5 to 7 year hold. Primary markets are a little bit different in an exit strategy than a secondary and tertiary market. So I have to be very aware of how those exit strategies work and how I play that. So hopefully that helped you out there. The exit strategy also is this. Part of multifamily, what I look at is your net operating income. Okay, your net operating income will dictate a lot of. So many questions coming through. But your net operating income indicates, based on the cap rate in that specific area, what you'll be able to sell the property for. Okay, so something you should look at, and something we do here at MF Capital Partners is, if I send you a business plan and I tell you that it's 18% returns, right? 18% returns is based on an exit cap rate, and it's based on our ability to increase the net operating income, which we call the NOI. Okay, so one of the questions you should look at is, on your underwriting, how quickly does your NOI go up? That's going to tell me how quickly I'm going to increase rents. How quickly am I going to increase other value add opportunities within a property? But if that's something you look at as an investor, right, and you're looking at, their NOI and their increase and their, how quickly they expedite it, that's going to tell you how quickly you'll be able to exit that property. So hopefully that helps you guys out there a little bit. So let's go up to the top here. So new. I haven't had a team yet. Just bought some land in Belize. We are actually partnering up on a deal in Belize as well. You have to let me know what part of Belize are you buying some land at? Looking to build out commercial use. Here's the thing: Belize is a phenomenal area to invest in right now. Okay, it's a phenomenal area to invest in. And so, you look at a lot of like international places, and tourists. You look at hospitality in general. COVID, it took a big hit on us. COVID, implementation of multifamily commercial use hotels, right? It impacted a lot. Well, COVID ended, and guess what? A lot of people wanted to travel. You look at cycles, and you have to look at cycles and how cycles work. Cycles work very differently in hotels as they do multifamily, but they're synonymous in a lot of ways, right? And so how we look at exit and acquiring is important. Right now is a time of hospitality, people traveling, getting out of their own way. During a recession, which we're in, 2 years of declining GDP growth, we're in a recession. The reality is people are looking for different opportunities. They're looking to get out, right? You've got to look at hospitality as one of those areas. Orlando is one of those reasons of why population growth is coming down to Orlando, which is allowing us to keep our purchase prices where they're at. Buying here, you got to be very careful because, the purchase prices haven't gone down yet. Remember, we want to buy at a low price, we want to sell at a high price. And so you're seeing a lot of these properties come due, and they're coming more and more available to be able to purchase at a lower price. Cap rates are going up, right? Interest rates are up, which means purchase prices go down. So a lot of the properties, just like you look at Arden Place that we closed 30 days ago, we bought that because the seller was going to lose it. The seller was going to lose that property. We got it $32,000 a unit under market, which is a phenomenal thing, right? It's a phenomenal thing to get those at that rate. Sucks for the seller, right? But unfortunately, they didn't plan well enough to be out for certain things to happen. We got that property at $9 million. They should have sold that, sell that property. They should have sold it to us for around $12.5 million. But we take advantage of that, right? We take advantage of the market. We're constantly looking at different opportunities and sellers where they're struggling with their property, where we can go and take advantage of it and be able to put it into our fund, right? Part of this call is this. I'm going to tell you guys an opportunity that is phenomenal to invest in the marketplace today. It's phenomenal. And Jay, I'm not sure whoever's on this, if you can post some links in the Q&A, or if we'll send it out to you guys of links of how to invest with MF Capital Partners. We have a slew of deals that are out there right now that have amazing returns, and looking investors for you, just like you, to invest with us. Is there a detailed walkthrough on entering our side of the underwriting template? Yeah, I mean, Laura, we can actually walk you through on an up and coming webinar we're going to do. How do I look at an underwriting? How does our team look at an underwriting and determine if it's a good deal or not a good deal? I would assume most of you guys want to look at that. If you're looking at an investment opportunity, you should look at that. If you're not familiar with financials, you may just look at the returns, but there's more questions you should ask. Hey, how do they get to the NOI? How do you get to rental increases? Did you do a detailed example of deals in that specific area to increase rents, to increase premium units? How did you come up with that number? Hey, are your expenses up there? Did you account for insurance going up? Did you account for taxes going up? So Laura, we can definitely do a future webinar on underwriting. Fannie and Freddie watch list, questions due to commingling. Is it worth pursuing? Yeah, I mean, Cassie, I'd have to understand your question of commingling, but Fannie and Freddie, what they had to do is they were getting behind it. A lot of these loans that were coming out were all bridge debt, right? Meaning you had to stabilize the asset, and in stabilizing the asset, it left a lot of issues out there, right? Fannie wasn't making as much money. Freddie wasn't making money. People didn't want to borrow from them because you didn't have a stabilized asset. So what Fannie and Freddie did is they made it more money, a little more available for us as operators to be able to go out and get loans. Some of it requires a little bit more of a down payment, but the thing is, we want to get into a Fannie Freddie loan. So Casey, I appreciate the question. The deals that we're looking at right now, we're not looking at bridge debt at all, right? We're not looking at adjustable rates. So one of the things you should ask in an operator in MF Capital Partners is really, what type of loan structure are you getting into? You want stabilized debt. You want fixed rates. You don't want these adjustable rates. Why? The Federal Reserve has come out and they've actually said the interest rate should be going up a couple more times by the end of the year. So you don't want to ever invest with someone who goes into an adjustable rate at all, right? Unless they have an extremely strong business plan of how to get there. Hang on one second, real guys. They're actually telling me how to enable the chat list. Awesome. I'm actually, guys, Imran, I'm not sure if you're on here. They gave me a link to give you guys to be able to schedule some time with us. I think I would have to do that in the chat area. I actually can do it to everyone. Look at that, guys. Technology maybe is not my strong suit. Underwriting and operating a property is. So if you can see that, maybe put in the Q&A, or Imran, let me know if you could actually see that. If you guys want a chance to invest with us, you're looking for opportunities, you want to talk to one of our investor relations specialists, you can click on that link there. I'll put it a few more times. So hopefully that answered your question, Casey, on Fannie Freddie. Let's see, next question here. What are your favorite exit strategies? We actually just went over that. What industries are you investing in? Yeah, so really, Stephen, we're looking at primarily multifamily. We are looking at some hospitality plays as well, meaning hotels. We've looked at that. The returns on those are phenomenal, right? You're looking at 30+% returns. But remember, Stephen, we always look at risk. I'm very big on risk management, And so one of the things we look at is, hospitality is in its cycles as well, right? Investing out of the country, has its risks also. And so the industries that we're currently looking at is specifically multifamily. We've looked at some mixed use. We've also actually looked at storage units as well. So those are kind of what we're looking at. Currently right now, all multifamily. That's what we're familiar with. That's what our track record is. We're looking at mismanaged properties. We're looking at properties right now where owners are going to get ready to lose those, right? We want to scoop those up. Like I said, it sucks for them. I feel bad, right? But once again, it comes down to planning. How are you properly planning right now? Paul, there was a deal that we got into. The question was, was there a time that you purchased a property, right, that you realized you made a bad idea? Listen, you have to learn, right? We have a saying is fail forward. There was a deal that we got into that we sponsored a deal for some people. And in getting that deal, they did their repairs and maintenance on a 68 build. It's a 1968 build in North Dallas area. It was specifically Denton, which is a phenomenal market. And in that deal, in partnering up, there was a general contractor on the deal with us, and he said, "Man, we could do repairs and maintenance at under $400 a unit." And I said, "There's no way in hell you could do that. Absolutely not." Well, I let him convince me into it, right? Well, the reality is there was a freeze in Texas a couple years ago, and you know what? A lot of pipes froze up. There was a lot of damage. Okay, part of repairs and maintenance allows us to bring maintenance costs or maintenance people in to fix specific areas. We actually have capital expenditures or a CapEx budget that allows us to go in and fix major items. Had we stuck to the higher amount that I wanted to do on that deal, which is around 800, we would have had some of those cash flow issues. Now, with that being said, that issue, the investors on that specific deal, they got a return of 18.2% return. It's one of our worst deals that we've done. It's the worst deal that we've done. We told investors that they would get close to 18.9%. Now, that deal we acquired right at the beginning, actually 2 months before COVID hit. So imagine our business plan that we had, we were not able to implement. In that implementation was, student housing. There was 2 colleges that were within a 3-mile radius. There was one was less than a mile away from the property. And so we had to, one of the greatest things with us is we're all solution-based, right? MF Capital Partners, we're very solution-based. We get together and we talk about the solutions that we can get into. One of the things during COVID that people had was, they didn't have jobs. They didn't. And so what we did is we brought a social worker in to work with them. Obviously, the management company was a bad person, right? They were the villain. I live in Orlando. We'll talk Disney terms, right? Just like our place was a gym. It was a complete gym, right? So the reality is we get together and go over solution-based, which was the social worker. And that social worker was able to help find people jobs, help people find opportunities to get into, to pay their rent, right? People, believe it or not, man, they don't want to not pay their rent. You have your few select people that, man, hey, they're going to take advantage of the system, and that's always the case. But a majority of people, man, we believe in people. They want to pay their rent. As we provided solutions, they were able to do that. The fact that we were able to sell it, our investors came back and said, man, the fact that we're getting 18.2% returns was amazing. But the amazing part, Paul, is this. At MF Capital Partner, we believe in investor relationships. We believe in the investor experience. On that deal, MF Capital Partners didn't take one dime, right? We didn't take any money from the sale of that property, which we could have, right? The deal was 70-30 split. We could have taken 30%. Had we done that, the investor would have got 12-13% return on their money. For us, man, sticking to the business plan is important. It's a long-term play for us. It's a long-term, right? We're not going to make decisions based on a one and done deal. If we made decisions based on that, we would lose investors all the time. And I think you would find that a lot of our investors we have, they would tell you that, that exact thing. How do we invest $100,000 in a specific property, or does that go into the fund? Hey, Trace, awesome. I'm glad that you brought that up. Okay. Naples, beautiful area. Love the golf there. If you want, we can golf sometime. I love to golf. So 100,000, I would say I just put the link up there again. If you can see the link, let me know. But click on that link. We do have future opportunities where you can invest directly into the property and into the fund. Guess what, guys? The beautiful part of a fund is this: it's diversification, right? One of the deals that we sold off a portfolio. That portfolio was 4 different properties. Those, remember, we sold at the height in 2021 on it. The height of that, right, or the lowest return to investors was 30% annual rate of return. The highest was like 54%. The average was 39%. You can imagine the 30% people said, Matt, how do I get into the bigger deal? Anything in real estate, if you've invested before, you know that diversification is the best way to do it, right? You want to diversify. We have, a couple deals in the Aloha Fund right now that are performing extremely well. If you just got stuck in one deal, you just get the performance of that. But the reality is this: if you're looking for 16 to 20% returns, you want to make sure that you get into a deal that, what if there's a bad deal? What if something happens? Is there bad deals with operators out there? Absolutely, nothing's perfect in real estate. But are there phenomenal deals as well? So here's the thing: if you want consistent returns, funds are always the way to go. If you want a deal that could perform extremely well, go into a deal specific, right? But that's you as an investor that you have to decide what is best for you all, right? I guess I should say y'all, if you're, people from the South Texas. I have a lot of family from Texas. Y'all is probably shorter, but yeah, you got to make, sense of what makes sense to you all. So awesome. Really quick, I got to get a quick little drink here. Awesome. So would you recommend to someone who recently lost a job, no money to invest? For someone who recently lost a job to invest? Absolutely. You got to do what's best for you, right? Regardless of losing a job or investing, those are two different things. A job is cash flow. A job is going to get you money, whereas investment is long-term. What is the long-term goal that you're looking to accomplish, in that? So you have to make the best decision for you and for your family, right? If holding on to that money is going to benefit you short-term, absolutely. Once again, investments are long-term. What are the ranges, percentage of deal sponsor, deal finder, capital raise, asset manager? That's more of an education question, guys. Typically, how we sponsor within it is there's a sponsor, the deal finder, capital raiser, asset manager. In an education standpoint, as operators, typically most operators would split it up. Sponsors get the most because they have to sign on a loan. People who find the deal get X percentage. If you send that over on the other side, we can ask that question for you. Not necessarily an investment question. I'm looking at Tulsa County, Oklahoma market for multifamily. I read that year-to-date 2023, they've only sold Class C buildings. Does that mean it's not a good market? Janelle, I'm going to tell you this. I want to put out an ugly, it's called the Ugly Duckling Survey, okay? Meaning this, most investors, and this is normal, most people, they want to date good-looking people, right? So this is why I call it the Ugly Duckling Survey, you can never judge a book by its cover, right? I'm 45 years old. Obviously, my wife is very beautiful. She has substance to her. She's amazing. Now, with that being said, properties, people look at properties the same way, right? It's human nature. People look at a good-looking Class A property and going, hey, man, the returns are going to be there. When the reality is, if we did this, if we sent over a survey with a good-looking property versus a bad property, the majority of investors would pick the good-looking property. Why? Because they just don't understand it, okay? They don't understand that good-looking doesn't mean good returns. If you looked at our track record, most of our track record is Class C properties. Okay, Class C properties has gotten the over 20% return to investors. Why? They're mismanaged. Let me tell you about Orlando Sky. It's in the fund currently right now. Orlando Sky was $300 on a market rent. In less than 6 months, we had already accomplished our one year projections. Why? Because as those leases expired, right? As those leases expired, I just had someone say slow down a little bit. I get passionate because there's 53 questions. I'm trying to get through those. So, as leases expire, we can take those to market rent, meaning if they were at $900 and market rent supports the $1,200, then as the lease ends, we're going to charge them $100. So, that $1,200 gets us to closer to our business plan. A lot of people say, hey, do you have 3 to 5 year hold times? Well, guess what? That 3 to 5, we want to exit in 3 years. We don't want to hold for 5 years. Our money, we invest alongside you, right? We want to invest alongside you. We want our money to work for us. A lot of times we take our acquisition fees and we put them, into the deals with you guys, and so, with that being said, we would like to turn those around in 3 years. So, when you're going to Oklahoma, the Oklahoma market, Tulsa specifically, yeah, if the C deal pans out and the returns are great, do it. If the purchase price is low, is every deal doable? No, right? I mean, purchase price does not indicate what your returns are going to be, right? You've got to look at everything on a deal, right? We don't look at just purchase price. We look at income coming in. Can we force appreciation, right? Can we manage our expenses, right? Meaning, if we can lower our expenses and continue to increase income, right, your profitability gets bigger and bigger, which means our return in cash on cash to investors increases. So for me, purchase price doesn't really matter. So someone just asked, you're changing our criteria investing in states other than Florida and smaller properties. Why? Yeah, so great question. As market changes, if you would agree, the market's changing, right? The market's changed for a while now. You know, all that Trump did was he lowered interest rates. So during the time, it was great, right? It was great for people selling properties. Well, you're starting to see some of the side effects from that, right? So you're starting to see cap rates go up. You're starting to see, inflation happen. There's a lot of different theories on how that worked, right? But, as the market shifts, your criteria has to shift as well. So most investors, they're looking at either cash flow or equity, right? Which they're going to look at returns. Most people, if I asked you, if we said 16 to 18% returns today, you would say that's pretty good. Most people are getting 5 to 8% on their returns in stock markets, maybe single family housing and whatnot. But the reality is the market is at 16 to 18%. It's no longer at the 18 to 20%. And so, right, that criteria changes. It changes with the market. It also changes in this. If we know that our investors want cash flow, well, the Midwest properties are a little different, right? They're going to cash flow a lot better. Okay. I would say they're almost recession proof. They're more for tenants than they are for home buyers. And so I want to know which markets we want to go into. More importantly, the primary markets during a recession or during an economic downturn are no longer the markets you want to go into. You want to go into secondary and tertiary markets. Why? Your expenses are a lot, more controllable. Florida insurance is a lot higher. So I want to get out of that where I can control my expenses. And so if I can control those expenses and go into a market like South Atlanta, there's a market just outside of South Atlanta, Warner Robins, where we just closed the first deal. Well, they reassess taxes every 3 years as opposed to the bigger areas in Texas, right? They're doing it every single year. Well, as property taxes have gone up because of the purchase prices, right? 2020, 2021, purchase prices were out of this world. And so, that affected real estate taxes. And so you're starting to see that drastic incline in real estate taxes, which are affecting returns to investors. So what we've chosen to do, JJ, we've chosen to go into different markets. We've chosen to go into smaller markets where our returns can still maintain at a higher level for our investors. Hopefully that answers your question. Let's see here. If you don't mind, I'm going to skip through some of these questions. So where do you see markets right now for the end of the year? What's going to happen at the end of the year, Leah? The market, you're going to start seeing political gains. The political gains influence the Federal Reserve, right? Why? Because politicians put whoever they want in the Federal Reserve. So it's going to follow who's ever in the market. Well, guess what? Every politician buys votes. So what you're going to see is interest rates starting to come down. You're starting to see inflation obviously come down. Well, as inflation comes down, interest rates should come down, which means cap rates should come down a little bit. So you're going to start seeing a lot of people buy deals here at the end of the year, going into quarter 1, quarter 2 of next year. So really, this quarter four, quarter 1 of 2023, quarter 1, quarter 2 is where a lot of people will scoop up properties. Meaning that we're buying it just like the deal that we just closed, Arden Place. Mind you, that's in the fund as well. In fact, I'm going to click the link, guys. If you want to invest with us, you want to schedule time to talk to one of our investor relations, click that link and schedule some time. And you can see one of the reasons I talk fast is I'm so passionate about this market. I've made a lot of returns. I've made great money, and our investors have made a lot of money. So I'm very, very passionate about it. One of the things that I do, one of my roles is to forecast, is to look at the market, where the market is trending to, how is it going, and those are the things that indicate how our returns have been with our investors. There's reasons why our investors have received over 25% in their returns. But really, to answer your question, Leah, quarter 3 of this year, quarter 4, quarter 1, quarter 2 of next year, you're going to see a lot of these properties, like the property that we scooped up. We got 32,000 in the market. They lost it because they made poor decisions in 2020, 21. Right? We just don't jump into any deal. We put a lot of thought into the deal, put a lot of thought into the exit strategy of those deals. What are the top 3 cities you would recommend looking at? Well, Nicole, it really depends on the market, right? Like, what are the top criteria? What are the top deals? I would need to know your question. Is it top big cities? Are you looking at Austin, Provo, Utah? Are you looking at Austin, Nashville, Boise? Those are some of the biggest large cities and some of the increases. You want to look at smaller cities, you're going to look at Idaho Falls, you're going to look at Logan, Utah, St. George. And guess what? You know, one of the biggest markets here in Florida for smaller cities is the Villages, right? You look at population growth coming here. You got a lot of your East Coast people moving down into Florida right now, specifically into Orlando. The Village is one of the top small cities. So hopefully that answers that question. Great question. Have you acquired a property through a delinquent tax deed deal? You're going to see a lot of delinquencies, Jeremy, here right now. And those are the deals we'll scoop up on. So I know doesn't answer your question specifically. That's a very detailed question. But, you know, delinquency in general, right, where they're going to foreclose on the property. That deal we got in Arden Place south of Atlanta was a deed in lieu of foreclosure. Guess what? You're going to see a lot of delinquencies, guys, here. We want to be ready to scoop up on those deals. The fund, that's why the fund is so important, right? A lot of people want to go into deal specifics, you know, but the reality is this, you know, the fund, you know, it offsets any kind of, I would say liability offsets. Really, it's just diversification, right? It allows you to maintain a consistent return. You know, the deal specific where these people went in, these operators went in, they lost the deal. You know, you're going to see a lot of that, and it's just proper planning. If you want diversification, the fund, once again, I'm going to reiterate that it's the way to go. Consistent returns versus, guess what? You may get that one deal that gets you 30, 35% return, but you may get that deal that gets you a 12% return. You know, you're kind of rolling dice on it. Amanda, good to see you on here. If you're a new investor as an LP, what are specific or the most important things you suggest we learn or do in order to make wise investments? Criteria of your operator. How many deals have they gone full cycle? We've done 28 deals in our total portfolio. We've done 13 deals full cycle. Okay. I would ask what their cash on cash is, Amanda. You know, on their deal, what was their projected cash on cash? Meaning it's not the preferred return, it's what the deal does, right? So if you're going to go into a deal and it was 4, 5, 6% cash on the first deal, right? What was it when they exited? Okay. Like for us, it's 7% on our on acquisition. Acquisition, most of our deals were at 7%. When we exited, they were closer to 13%. Well, what does that tell you, right? It tells you that they have the ability to pay a preferred return, or that deal was able to cash flow and pay me cash flow payments. So that's one thing I would look at. I would look at their business plan, right? How do they spend their CapEx? Does their CapEx indicate an increase in income on those specific properties? And if so, right, then those are the questions I'd ask. How do they spend their CapEx, right? Do they have CapEx left over? Do they spend all of it? Is it indicative of the returns that they're getting, right? Did they do the proper homework on taxes, right? You know, each county is different. Each state is different of how they reassess their taxes. Does it reassess it at the purchase? Does it reassess based on the market? So I want to ask those questions. Did the operator do enough homework to look at that? Insurance, right? What's going on with insurance? Is it going up? Did they put those accordingly in their underwriting? So Matt, great question. Okay. Hey, so we're getting some questions based on like operations and not in operations, but more of an educational question of how operators operate. Those are more education questions. We want to make sure we're answering questions on the investment side specifically. All right. So if I do see those, I may skip past them. How can I classify as a real estate professional being an LP? Are you putting 750 hours into it as a business? As a GP, are you actively involved on the GP side of it? If you're on the GP side, you're accredited investor, a real estate professional. I'd ask your CPA on that. Really, you have to put 750 hours, and then there's really sometimes a cap if you're a real estate professional, if you're looking for the tax benefits. So really, Adam, I would say get with your CPA to answer that question. But really, the answer is 750 hours. We sponsor a multifamily at an auction. We don't deal a lot with auctions, but I mean, I'm not opposed to it. If someone doesn't have the capital and can help with sourcing and underwriting qualified, you know, what the question is if someone knows people with money, could they bring them and refer them to us? Harish, yeah, absolutely, man. Click on that link. You see it in there. Click on that link and schedule some time with them, man. Right? Usually, in order to have a partnership like that, you've got to do over 500,000 to $1 million is what we do to entertain that. If you have investors like that, schedule some time. They'll talk to you about how to get into that part of it. Really, you're looking at funds of funds. You look at those opportunities, but they'll be able to walk you through it. All right, sorry here, guys, reading through all these. If you have friends outside of America, will still be able to have tax advantage if they invest? Is there any difference between domestic and foreign investors? Absolutely, yeah. They want to get into it. My understanding is there's a big difference between LLPs and LLCs. We've had Canadian investors come in, and investors out Saudi Arabia. Anyway, they invest through an LLP, not an LLC. There's tax benefits there. Once again, get with the CPA, get with an SEC attorney, Lucy. They can answer that question for you. We have foreign investors. What you pay, we have to pay a little bit differently in our Form Ds when we report them. And so there's definitely ways of getting foreign investors in. So tax advantage, unfortunately, that tax advantage, tax benefits is here in the U.S. Whatever their tax benefits are in the country you're in, they'd have to address it there. When I bring investors into a deal, there's a property NCP offers and it closes. How am I compensated? William, once again, schedule some time. That's a more in-depth question, William, on it. Obviously, it depends on how much that you have. We would prefer you to set it up as a fund of funds. It protects us. Once again, it really just depends on how much an investment money that you do have. Awesome. Let's see here. Raising capital, can credit cards be used? We don't use credit cards, Dion. Really, you'd have to take cash out and invest it through that, deposit into your account, and invest through your account. So we don't do credit cards. There are tokens that you can get into a different way to invest. Credit cards are just not one. How do you calculate the amount of tax offset based on cost seg study? Oh my gosh, how I know Brett would ask that question. So Brett, the way that we do it in today's market, because remember last year was 100% on bonus appreciation. This year it's 80%. Really, the way that I do it based on the purchase price is I take 30 to 35%. Okay, based on the 30 to 35% of purchase price, that's going to give me the overall tax or depreciation that I should see. It's pretty close, actually. So based on the 80%, I would take that number. So let's say that number got us $5 million in depreciation. I now take 80% of that. That 80% would get you what you should do. So I should know that number. I'm speaking too quick, so I'm gonna get you the exact number here. $4 million, right? So $4 million is what you would have now in today's market on that depreciation. That's how I calculate it. Obviously, depending on how old the property is, what the property is, the appliances, all that, the 5 and 15-year accelerated depreciation is going to determine as well, right? Remember, every company is different as well, Brett. You've seen that with different companies of how they do it. Some are a little more aggressive than others. And so that is a good rule of thumb, though, 30 to 35% of purchase price. So first step, Teresa, is how do you invest in multifamily properties? Schedule some time with us. I put the link in the chat area there. You can schedule some time. You can fill out a profile. If you know that you want to invest with us, our funds currently right now are for accredited investors, right? Currently right now, it's $100,000 or more to put into it. Now, sometimes that doesn't work. Give them, talk to them. There may be some options there, right? We do have opportunities where you can invest in deal specific. Those will be up and coming in the next deals that we do. So once again, click on the link, get with us if you're interested in future webinars. Awesome, great question. I actually had a lot of people ask the question, how do I invest with you? I'm not accredited currently, any opportunities to diversify. We're actually gonna have a deal that we just submitted on. We have an LOI, we submitted on a deal in Tulsa, Oklahoma. In that deal in Tulsa, Oklahoma, our team went and found it. Actually have one other deal that we may have an answer on this week or next week. Sorry, it'll be next week. Today's Friday, the week's on my fast. So we have 2 deals out there with LOIs in on them. The next deal we will have opportunity going as a non-accredited as well. Great question. Someone said they have single family rentals. Would like to get into multifamily. Andrew, sell those off, man. I couldn't agree with you more. Right? I did single family. It's how I actually started single family opportunities. What did you do as far as adjusting your exit strategy? If you realize you're in the middle of an upside down deal, for whatever reason. Yeah, Jeremy, it's all about solution-based, right? What's going on with the market? Is it changing? You know, if we were holding on to a deal for 5 to 7 years, let's say, or the term of it 7 years, right? Investors really want to know what's going on with the deal, right? What's happening? What's going on with the market? Are you accounting for adjustable rates if it is an adjustable rate loan? What I'm going to do is I'm going to go in and I'm going to update our underwriting. I'm going to go into the second, third, fourth, fifth year, and then I'm going to let my investors know what's going on, right? So it's important to let your investors know, how the market is going. How are you performing your assets? They understand in today's market that there's a dip in the returns, right? There's a dip in how, what our strategy is. Letting them know what the new strategy is and keeping them informed is going to keep your investors with you. So, once again, to answer that question specifically, if you're in the middle of an upside, guess what? As an operator, it's my job to protect investor money, right? It's my job. There's solutions for everything that you approach in this business. And that's what's beautiful. When you're single point focused and you only focus on the problem, you'll never focus on what the returns could be. So there's a solution. We may have to raise more money to put into the deal. We may have to buy the loan down a little bit, right? And that may be a solution, but it may be a long-term solution. You don't want to be in the situation where these operators don't think, ahead. They're not forecasting. It creeps up on them and then they lose the deal. All right. Yeah, is there a good property? Who do you guys use for property management company in the Orlando area? We use AMC. They're amazing. That's who our preferred property management company is. You're looking right now, this is an important question. Our property management company that we have on site, they own over 127,000 units in different areas, over 300 properties throughout the United States. They're in 26 different areas in the United States, 26 different states. So, what's important on that is what is their track record above what the pro forma is of the operator? Well, our AMC is 2.6% above pro formas. So that's why we use them. That's who we use in Orlando. All right, guys. Someone says something bigger. They want to work on bigger deals with us. If you're interested, Paul, hit us up, click on the link. Let us know what deals you're talking about. We'd love to entertain something. All right. So primary method is through the deal specifically. We actually use CoStar. We're looking at that to see, what current owners or how they're operating their properties, when their loans are maturing, how to get in that. So really, guys, we've gone about 50 minutes. I want to respect your time. I'm going to close out the Q&A and I'm going to leave with this. Within our fund, a lot of people have questions, right? They're having questions on, how do you operate your funds? What type of deals do you have? And how do those deals operating? Well, the Aloha Fund, we have the Orlando Sky, we have Arden Place. Let me tell you a little bit about those deals, right? Is how do we pick them? We pick mismanaged properties, right? Remember, I say the ugly duckling. I love the ugliest deals. I love equity because as we accrue more equity, we accrue more cash flow down the line, right? We're able to reinvest that equity to make more money. And so Orlando Sky was a phenomenal deal. One of the biggest reasons, it was in a declining, or I'd say it was in an area that most people look at and say, why in the heck would you invest there? The reason we invested there is because, in looking with the Economic Development Committee, they were putting $1 billion into this area in the Rose Art District. The Rose Art District is a little less than a mile from where our property's at. So imagine as the city is putting money into the area, it's forcing appreciation in that area as well. More people want to move there. And so in this deal, it was $300 under market rent. And so as we went in there, we were able to increase those rents. As leases expired, we were able to move those leases to market rents. Okay. Now, if we upgraded those units, we were able to increase those units an additional $200. So on a lot of these units, we're getting $500 in increased rent. You're looking at a lot of our renewals are 21% above where they were currently at. I want you to think about it, 21%. Okay. So if you were to take on a lot of the increase we're having right now, on average is around 20% on this specific deal. If you invested $100,000, what does that mean for you? Let's say the NOI went up 20%, right? That's around $20,000 that our investors that invested into the Aloha Fund have accumulated, right? $20,000 on a $100,000 investment. It's great deals. So what we've done is, when we acquired Orlando Sky, expenses were extremely high. Why? The thing is the seller was so caught up on 100% occupancy. We don't believe in 100% occupancy. You have to have a healthy vacancy in there, okay? Meaning that you're pushing your rents high enough. Remember, we want the NOI to go up, right? It's in direct relation to what your exit should be. If the NOI is going up and you're asking in the business plan, at exit, what should your NOI be at? Where is it at today? Well, those are questions you would ask as an investor. Is, hey, I noticed that your NOI is here. You said you'd be here. What's going on, right? And so with that on Orlando Sky, man, we've increased the NOI 20%, man. It's phenomenal. So we're already halfway through our business plan in a 6-month period. So Arden Place, we closed on 30 days ago. What I love about it is this. One thing we look at is, what are the concerns of investors in the market? What are our concerns? One of the biggest things was adjustable rates, insurance going up, property taxes going up. And so we moved into the Georgia market. So the Georgia market in this area is, they reassess taxes every 3 years. It allows us to control our cash flow to investors. So that was important to us to go to a market where they reassess taxes every several years. Let's say they go in and reassess taxes one time. We know that our exit is going to be sooner than that. And so we're able to control what the returns are to our investors, right? We want to look at property taxes and the rate that property taxes are going up. And so, with that being said, we decided that Georgia was a great market. We decided in going to that market, we wanted to see who was going to be losing their deals. And so Arden Place, mind you, I've already said this twice, we got it for $32,000 below market rent. Okay, $32,000. What did that equate to? It's a 114 unit deal. It equated to almost $3.7 million. As a discount, some people look at that as instant equity, right? Now, instant equity is as long as the market cycles goes and we allow it to play out, I want you to think about this. That's a 61% return to investors. So I tell our team all the time when talking to investors, all you got to do is not screw up. Arden Place, all we have to do is stabilize the asset, and the return to investors would be approximately 61%, right? Now, when we implement our business plan, that one's $200 below market rent. As we implement that and we increase those returns become more and more, right? So once again, the NOI goes up and up. All we did is got it at a discounted price because the seller was mismanaging. All right. There's several other factors in the Arden Place of why I think it's super attractive, super sexy. One of the reasons it's a tertiary market, right? It's a market that a lot of people aren't going into. They're going into these major big areas, right? They're going to the primary markets where the returns really aren't there. I want you to think about this. When rental prices go way up, where does the renter go? They're going into other areas. They're going to the areas where they can afford it. They'd rather spend their money in gas and fuel than they would on rent. Okay. So, but what happens is a lot of these companies come in the labor market. Which you look at Arden Place, it's a 12% year-over-year job growth, right? We want to look at those. Population growth, it's one of the biggest areas, in the state of Georgia in percent increase. So we want to look at that. We know that people are going to stabilize, they're going to stay there, and they may eventually, keep their job there. So once you think about it, 12% year-over-year job growth, you're not seeing it anywhere. That's why we pick markets. In Arden Place, I say this, it's a diamond in the rough, right? It's a little Aladdin phrase there for some of you people. And so it's a diamond in the rough. You're not seeing deals like that anywhere. But those are the deals that we're looking at right now. We're looking for mismanaged properties that we can go in, control the expenses, and get good returns to our investors. So I'll say this once again, man, every decision that we make at MF Capital Partner, right, is based on investor experience. It's not based on the operator experience, which a lot of operators out there, they're going to put it in their pockets. They're going to put the money in their pockets, right? They're going to make decisions based on what benefits them. For us, we want long-lasting relationships with our investors. We want you, just like the deal that we sold, the portfolio we sold off in South Carolina, 80% of our investors invested with us again. 80% of them, okay? I want you to think about it. There's a reason why they invest with us. We under-promise, over-deliver, okay? Even though we underwrite a deal and it says 24, 25%, What did I tell you? In today's market, it's 16 to 18%. We want to make sure as we tell you that, right? And a lot of you said, I'd invest. Absolutely, you'd invest. I went and met with a financial advisor the other day, and they're wanting me to put deals into 6% returns, 7% returns, 10% returns. And I politely asked, why would I do that? When I know that our deals, even at a lowest amount, our worst deal was 18%. Even if it was at 16%, would I invest in our deal or would I invest elsewhere? Right? That's for you guys to decide, right? There's ebbs and flows of the market. There's cycles and everything in stocks as well. But the reality is we all know that wealth is created through real estate. We know that, right? MF Capital Partners, once again, there's a term, it's invest with aloha. Aloha, right? As Tyler would tell you, Tyler's he's my managing partner. He's my partner. We've been for 8 years, okay? We would look at it and go, and aloha means I see you and I breathe life into you, right? Meaning there's an action item. One of them is I see you, right? The other one's an action item. What can we do to keep you what can we do to keep you as an investor, right? Through newsletters, through updates, through setting proper expectations, through transparency, right? We want to do that here at MF Capital Partners. We want to know what your needs are, and we want to know all about you, right? We have a lot of investors where family, their kids. We call ourselves Ohana. One of our offices in Maui. We use a lot of Hawaiian terms here, but we truly believe in family, you guys, and benefiting and blessing your family. Like I said, we invest alongside you guys. Our money works with us for us as well, right? And I think that's very important in an operator. Amanda, you asked, what questions should we ask? What % of the money are you guys investing in deals? In our last fund, the Akahi Fund, we invested over $1 million. This one, we're close to $1 million as well. So with that being said, guys, look, love and appreciate that you guys attended and asked questions. I do apologize that I didn't get to every question. That's not intentional. We're only left with a certain amount of time. We will do more like this. Hopefully the next one we can get Tyler and myself on as well. But just so you know, and you can see, we're very passionate in what we do. I'm very passionate. I've seen the benefits to my family, and I've seen the benefits to each and every one of our investors who've invested with us. So once again, we always say invest with aloha. Thank you so much for your time and your questions. Once again, if you want to invest with us, you have questions for our investor relations team, you have investors that you want to refer to us and bring in, schedule some time with us. We'd love to do that. Who knows? You might get me on the phone to talk about your opportunity as well. So once again, guys, invest with aloha. Thank you so much.